I'd like to welcome you today to our Beef and Forage Focused webinar. These are webinars that we hold on the first and third Tuesday of the month. And today, as we get started in our webinar, if you do have questions as we go through today's presentation, if you just like to type those in the chat box down below, I'd be happy to stop and try to answer those as we go through. Today we're going to look at livestock risk protection insurance as a risk management tool for calves and for feeder cattle. This presentation today is going to be a brief overview. There's a lot more details here than what I would be able to provide in the short time that we have, but I've included some resources with this presentation that I think are excellent reference material that you can go and look at and learn more about this as a risk management tool. Really, the things I'm going to focus on in today's presentation is how livestock risk protection insurance works, and then maybe what opportunities would it provide, particularly thinking about cow-calf or stock or yearling operators. Livestock risk protection is basically a risk management tool that's based off of the Chicago Mercantile Exchange Feeder Cattle Index. And that feeder cattle index is based off of a 12-state region prices from auction markets for number 1 and number 2 steers that go through that. And they looks at a 7-day rolling average of that, and that's what this risk management tool is based off of in terms of determining a value for the price. When using livestock risk protection insurance, what you can do is insure against lower prices and still take advantage of upward price moves. So basically it works like a put option if you've ever had any experience with something like that. With a put option, you actually go on the board and you purchase a put option, putting a floor effectively under those cattle. If you think the price is going to go down, then you've protected that price. When you purchase livestock risk protection insurance, the advantage is that you can use as many or as few cattle as you wish. When I say as many, there is a limit, up to 2,000 in a crop year. But if you're a smaller producer, you could insure as few as 1 head. And so you don't have to be putting together load lots of cattle to utilize livestock risk protection insurance as a risk management tool. Some of the advantages, and I already mentioned this, is you can insure anywhere from 1 to 2,000 head, and this would be for calves or feeder cattle. If you're looking at fat cattle, you can actually insure up to 4,000 head per year. Again, what it does is it allows you to take some protection in the downside part of the market while leaving the upside open. And that's, I think, the real advantage of this tool. The other advantage is that premiums for livestock risk protection insurance are subsidized 13%. And I'll show an example of that here in a moment. And so it is an advantage, I think, to the person purchasing it that you have that subsidy in place. When you purchase livestock risk protection insurance, you're going to pick a date based on the product available that's close to when you think you want to market those cattle. In the event that you need to sell those cattle early for some reason, maybe because of a drought or something else that has happened, if you have to sell those cattle prior to 30 days when the policy expires, then the insurance product actually goes with the cattle. It no longer stays with you. And so that's something to think about also as you think about the possibility of using this tool. What are some of the disadvantages of livestock risk protection insurance? Honestly, the insurance premiums at times can be expensive. And as we think about the market volatility we've seen, especially in the last several years, premium insurance for taking a position or buying livestock risk protection insurance has gone up. And so that's something to be aware of when you think about the possibility of using it. As I already mentioned, if you take out livestock risk protection insurance on calves or feeder cattle, or fat cattle for that matter, you can't sell those cattle more than 30 days prior to the ending date and still collect an indemnity if one is due to you. But on the other hand, that policy does go with the cattle, and so I can conceive of a situation where if you had a set of calves, you had a livestock risk protection insurance policy with them, the market had dropped and you needed to sell them, the person purchasing those cattle to put them on feed would still be able to collect the indemnity, and so it would still add value to those cattle. The other thing I think is the challenge with this is the insurance isn't always available. You have to really be checking daily to see the policies that are offered, and then you have to make a decision pretty quickly if you want to do that. The opportunity to purchase the insurance is only available from the close of the Chicago Mercantile Exchange until it opens the following day. And so what you're going to want to do is set up a policy or set up a account with a livestock risk protection insurance broker. Usually crop insurance agents also carry this product. So you want to go in, fill out the paperwork, and then you want to be watching at the end of the close, and you'll see what options are available, and I'll show the website for that here in a moment. Let's just walk through an example of how livestock risk protection insurance might work. I'm going to use an example from 2012 because I think it illustrates an opportunity to take some risk protection. If you remember last March, we had some real optimism in feeder cattle, and so let's say I had some stocker yearlings last March that I was planning to graze through the summer and then maybe sell in August. Last March 15th, there would have been an opportunity to take out a livestock risk protection insurance policy. I'm going to say that these steers were going to weigh approximately 850 pounds on August 10th of 2012. On March 15th of 2012, you could have taken out a policy that would have protected $1.49.93 per hundredweight on a 600 to 900 pound feeder steer. The cost for taking out that insurance would have been $2.47 per hundredweight, or a little over 2 cents per pound. With the Risk Management Agency subsidy of 13%, your true cost would have been $2.15 per hundredweight. So the cost in March of 2012 to insure that 850-pound steer that you expected to sell in early to mid-August would have been $18.28, and that would have protected that $1.49.93 per hundredweight, or $149.93 per hundredweight. On March 15th, if you went to the Chicago Mercantile Exchange and look at what feeder cattle futures were trading for, they were saying that 850-pound steer would have had an expected price based on futures of $158.73 per hundredweight. So that price protection that we could take out the policy on was $1.49.93 or $149.93 per hundredweight. The cost of protection was $2.15 per hundredweight. So with a price we actually would have protected is that $149.93 minus $2.15 or $147.78. That $2.15, we're saying we're taking out the insurance cost to see the true cost of the value we were protecting. The actual ending value on August 10th, as you remember, because of the drought, we've seen a drastic drop in price in feeder cattle. And so based on the CME feeder cattle index, on August 10th, we would have looked at $1.36 per pound, or $136.89 per hundredweight, which resulted in a difference of $10.89 per hundredweight. So because we took out the insurance policy, we'd have received a net of $92.57 per head on those 200 head of feeder cattle that we had in March by taking out this policy. Obviously, based on last year, it would have been a good thing to do in early to mid-March there. Some things I think it's important to think about as you think about livestock risk protection insurance and making it work for you. First, I think you need to know your unit cost production, know what you have in those cattle and what it's going to cost to put on a pound of gain. That gives you the opportunity to know where your profit point is and how you can take advantage of a price opportunity to protect a profit. I think that also makes it be effective as part of a marketing plan. I think it's really important here to put a marketing plan in writing, and I can speak from personal experience. When the market's going up and you have cattle, it's tempting to go ahead and let that market continue to go up if you think it's going up. And the unfortunate thing is sometimes if it went up today, you think it also may go up tomorrow. And so having a plan in writing, having some price points at which you've decided you're going to market or take some price protection out on a portion of those cattle, I think is really important. It kind of holds you accountable to make a decision when you've reached a point when you think you should be taking out some insurance and not just think, well, it was up today, maybe it'll go up tomorrow, so let's just keep going with it. Putting it in writing gives you some accountability. The other thing that is really important with this is you have to pay attention to opportunities daily. And I have an associate of mine who uses livestock risk protection insurance, and this individual sets an alarm on their phone at the close of the CME feeder cattle every day, and so it reminds them to go and look at what livestock risk protection insurance opportunities there are. And you really have to be paying attention because there isn't the same opportunities available every day. There appears to me to be more opportunities when the market is going up, and that kind of intuitively makes sense. As the market's going up, there's probably going to be more opportunities to get in. If the market's been going down hard, the opportunities to get in and purchase price protection against price moves down is going to be limited. I think it's also important to realize that livestock risk protection insurance over the long term is probably not going to make you more money if you took it out every year. But what it does is protect you against price wrecks. And I think an example is of what we saw last year. Last year there was a lot of optimism in the spring with livestock risk or with the feeder cattle market. And in that situation with the drought we had, livestock risk protection insurance would have been a money maker. There will be a number of years where it may not. And so I really think livestock risk protection insurance is for people who are risk adverse. If risk bothers you, or especially if you're a beginning producer or you have money borrowed against those cattle, and so you are trying to ensure that you have some profit or can repay your bank note, that's where I think livestock risk protection insurance has the most application. On the next page here, or on the next slide, I have a number of resources available that talk about livestock risk protection insurance. The second one here, the one that has price quotes, that's the one you can go to and look at what the options have been that are available. You can go back and also look at historically and see what options you could have purchased in terms of insurance and when indemnities would have been paid. Also shows the Chicago Mercantile Exchange ending values based on feeder cattle index, and you can see how that would work. And so if you're thinking about using this tool, if you're new to it, I would encourage you to go check out those websites and do some studying on it. It'll be helpful to you as you think about using that as an opportunity. The University of Nebraska Lincoln Extension also has some NEB guides and extension circulars that describe livestock risk protection insurance and how it would work in Nebraska. In Nebraska, we have a historically strong calf and feeder cattle basis, which means the prices paid usually here are higher than they are according to the CME feeder cattle index. And you can use that as a tool just as you think about what price you might expect to receive based on futures prices and also based on what you might get when you take out a livestock risk protection insurance policy to put a floor price on those calves, so to speak. The Kansas State Ag Manager information website also has some good information on livestock risk protection insurance and would point you to that also as a resource. Another good resource is by Dylan Fates, who's at Utah State University. He has a cattlemarketanalysis.org, and he has a lot of good information there. Also has some livestock risk protection insurance information. And so if you're looking for a place to go to find some good current market information, he also runs some break-evens based on current cattle prices and futures prices and also feed prices. Can give you some perspective on maybe what would be some opportunities for you as a producer to take advantage of this tool. Also, I personally use this tool, and so I didn't go into detail today in terms of how to use it as much as maybe some of you would like. But if you have questions about this tool after reading through some of the resources that are available, please feel free to contact me either by email or phone. We'd be happy to work with you on answering any questions you might have. With that, I'd be happy to answer any questions you might have. You could type those in the chat box if you have any now, and we could talk about them. All right, seeing no questions, this presentation will be archived at the beef.unl.edu website, so feel free to go back and review it there. You can also see the links in the webinar to those resources that I talked about from that as well, and that should be up and be posted in the next couple of days. The next Beef and Forage Focus webinar will be on Tuesday, June 4th, and so please join us again for that webinar on that date. Thanks for joining us today.